And today we're going to be talking about business principles. So just a quick look back on last week. We covered the introduction to financial leadership. We talked about what hotels are kind of prone to doing when it comes to not being so proactive with managing their finances. We talked about really what is financial leadership, and it's not accounting, it's business thinking, and it's really striving to make sure that everyone has their arms wrapped around their piece of the hotel, whether it be labor or expenses or both. We also talked about the three pillars of hospitality and how essentially the owner pays for everything, and investing in financial leadership has an excellent return on investment. We talked about the how-to versus the want-to, and really looking for ways to increase the want-to whenever we have a problem is a natural way to solve it. We also talked about the idea that perfection is probably really a bad idea, especially when it comes to running a hotel, or especially the financial piece. And lastly, we talked about these financial skills and what's in it for your career. So welcome back. Copy will be available just like last week. So use the chat for the polling questions, also answers and comments throughout the presentation, and Carrie will capture those and send them on to me. And we'll have open questions at the end. But if anybody has questions during the session, please send them in.
I'll also mention that sorry, David, if your chat isn't working, because I know it's not working for some of you, I just wanted to let you know that you can email me your answers and your questions.
Okay, thank you.
Okay, all right.
Okay, thank you, Carrie. So the purpose for these webinar workshops are to increase your financial leadership skills. You have a huge part to play in the successful operation and management of your hotel, no matter what you do. And numbers are your friend. They're really not as scary as you think. And you have a lot of impact, and releasing that is what it's all about. And I invite you to play full out and participate. And remember, shift your thinking. This is not about accounting. Shift it to learning, curiosity, grow your abilities. This is business thinking. This is the nitroglycerin for your career. With that, you can be cooler, you have greater career success. So we are building a foundation, and today's lesson is really about making sure that all four corners of that building can stand up by themselves. And if you've ever wondered why we do things the way we do, today is going to be a real eye-opener. And I know that that can be really frustrating when someone asks you to do something and they don't really explain why they need the information or what it's for. Sometimes you might even think that they're being difficult and maybe just pushing your buttons or getting you to jump through a hoop. You're going to see today that the reason for why we do a lot of things will come out of this. Okay, so the first thing I want to talk about, well, what is a financial system? Well, a financial system is a form of communication. It's a language. You want to practice the language, you want to become fluent. Once you become fluent, like any language, you can teach other people, build your skills, grow your ability to manage your business, grow your career. So that financial system is a universal kind of language. And if you can speak hotel financial, you'll be able to speak it to people all over the world. It's done the same way all over the world to a large extent. In hotels that are perhaps more organized or branded, it's going to be done at a different level, and we're going to talk about that. But understanding that system and being able to communicate is key. It's the key to your career. And it's important to remember that it's built on sound principles. And that's what we're kind of going to go over today as well. So first thing we want to talk about after that is the accounting function in a hotel. What are the operational areas that the accounting staff manage? Well, hotels are unique. So when we talk about the accounting function in a hotel, one of the things that's very unique about it is the accounts receivable department. So many of our hotels, we still give customers credit. And can you imagine getting on your WestJet or your Air Canada flight and having a master account? Well, we still do that in our business, and one of the reasons why we do that is because it's very competitive. Our competing hotels will offer that to our clients, so we need to as well. Also, it's the accounts payable department. We pay all the bills. Payroll, we make sure that everyone gets paid and the government gets all their tax money. We do day audit and revenue control, where every single day we have to balance the books in the hotel. Cash management, making sure we have enough cash. I always say cash is king, and if we run out of cash, well, it's a really big problem. Food and beverage controls, making sure that all of the food and beverage in the hotel are properly controlled, locked up, accounted for. We're in charge of the systems department, the IT function, the payment processing functions, and then purchasing, receiving in stores, tax, risk management, which is just a fancy word for insurance, and SOX. The SOX refers to legislation that is actually an acronym. It stands for Sarbanes-Oxley, and there are actually 2 U.S. senators that wrote the bill, but it's all about corporate governance. But if you're part of a corporation, that's something that goes on inside of your hotel. SOX. Got nothing to do with the Red Sox or the socks you have on your feet. It's an accounting function. So that's the areas that the typical accounting department looks after. So who uses this accounting information and why? This is really key to understand that the whole world wants to know what's going on financially inside of your hotel. So management departments within the hotel, obviously our owners, the people that collect our taxes, our customers, creditors, regulatory agency, investors, banks, everyone wants to know what's going on. So when we talk about having a language, we need to make sure that we're speaking the right language so people will understand us. Because if everybody did it sort of the way they wanted to do it and didn't follow a system, no one would understand what the other person is trying to tell them. That's why we have the system the way we do. So I'm going to switch gears now. I'm going to talk about the different types of businesses. And there are 4 main types of businesses. The first one is a sole proprietor. So I'm a sole proprietor. I'd be a great example. The fisherman, the farmer are typical sole proprietors. And there's no separation between the assets of my business and my assets. They're the same. And when I earn income, that's what I pay my income tax on, based on my income. Business is usually in their name, and the owner owns 100% of it. Therefore, the sole proprietor. So most of our businesses are actually sole proprietors, and quite a few of our hotels are as well. The second type of business is what we call a partnership. And that's where more than one person gets together to share their skills and experience, to combine those abilities, to share with that person. And in doing so, that person and the other people in partnership share the profits and losses. The taxes are paid on our share of the profits individually. And it's important to remember with a partnership, there is no corporate tax. There's just one layer of taxation. Now, the third type of, and I should mention here, a lot of hotels are partnerships. The third type, which is probably one that we're more familiar with just from a media standpoint, whatever, is a corporation. And what's important to understand about a corporation is that it's a separate legal entity, and it's separate from its executives and its founders. So for instance, a corporation would be the Ford Motor Company. The Ford family may be shareholders, they may be executives in that company, but it's a separate legal entity from that family and those individuals. The corporation is separate. And a corporation has 5 rights. The first one is that it has the ability to sue and be sued. So I might have a problem with the Ford Motor Company because of one of their cars. I don't sue Henry Ford's grandson. I sue the Ford Motor Company. And the Ford Motor Company might have a problem with me. It's not his grandson that sues me, it's the actual company. So the company kind of takes on a life of its own. It has its own identity. It has the rights to a common treasury, which means the money for the corporation is actually the corporation's money. It has the right to hire agents, people that work for it, to represent it. It has the right to a common seal, which means it can make contracts. And it has the ability to create its own bylaws. In other words, how will it govern itself? And probably most important when it comes to a corporation is it lives on after its principles. And the reason why is because people need to understand and realize that no matter who's in charge of the company, that company has a life of its own and it will live on after its principles. Great example of that is Steve Jobs. He died quite recently, and he was the head of the Apple empire, and it lives on after his death. So it lives on after its principles. And then the fourth business type is what we call a REIT in Canada. In the US, they're called S Corps. Excuse me. And a REIT and a corporation are very, very similar. But it actually must distribute, this is the big difference, it must distribute 95% of its earnings to avoid the second level of taxation, corporate tax. So in the sense of a corporation, the corporation pays two levels of tax. It pays tax to the government on its profits, and then it distributes dividends to the shareholders, and those shareholders have to pay income tax based on their portion of those dividends. So it's what we call dual taxation, or a second layer of taxation. But a REIT avoids that so long as it distributes 95% of its earnings. So it's relatively new, and it was actually grandfathered out in Canada about a decade ago, perhaps a little bit longer. And the reason why is that many corporations were switching and becoming REITs, big corporations, and the government was losing a lot of tax money. So they outlawed it, grandfathered it. But it has the same 5 rights as a corporation, and it lives on after its principles. And with REITs, a lot of our hotels are owned by REITs, especially in Canada. We have a lot of active REITs. So the REITs that were formed before the government grandfathered them, so therefore they can stay in business. So our first polling question of the day, what's the business type at your hotel? Is it a sole proprietor? Is it partnership? Is it a corporation? Or is it a REIT? And if you just put one of those 4 words of the abbreviation sole, partner, corp, or REIT in the chat, Carrie will gather those, and then when we come back in a couple of minutes, she'll give us the overview of what the landscape looks like. And I know some of you probably might not know, but let's take a shot at it. And maybe at the end, if people have questions on that, they can come back. But a good takeaway here is if you do not know what the ownership structure is at your hotel, it's your job between today and next week to find out, to get someone who can tell you. Okay, on to the next part, the principles of business. And here's really where some of the things that you've been doing in your career, you're going to go, oh, that's why we do that. So there are several key principles. There are more than what's on here, but I'm going to cover the main ones. The number 1 principle is to stay out of jail and keep the boss out too. And you might be chuckling to yourself just a little bit, but I want to tell you, I've worked in more than one hotel where people have gone to jail for doing things that are illegal, but also things that have broken some of these principles. So here we go. Principle number 1, the matching principle. So what does the matching principle mean? Well, in our world, in order to create a financial statement that makes sense, we need to match all of the revenues with all of the expenses. And that's really hard to do in a lot of instances. So it's a really important concept, because in and of the month, if we're measuring the profitability for the month of April, it's quite easy to determine what the revenues were because we balance them every day. But when it comes to our payroll, we probably get paid every week or every 2 weeks. So that doesn't fit into a calendar month. When we look at our expenses, I'm paying for items all the time, things from last month, things from 2 months ago. I'm prepaying some things. So in order to figure out what belongs to the current month of April, I've got to have a system to be able to do that. And the very foundation of that system is called the accrual accounting system. And at the foundation of the accrual accounting system is the matching principle. And the matching principle states that I will match all revenues and expenses irregardless of when the money comes in. That's the key part, irregardless of when the money comes in. So a really good example of that would be group clients. We may have a group in the hotel. They were there last week, the last week of April. I'm going to recognize the revenue for last week for their bedrooms and for their food and beverage. But I also need to recognize all of the payroll and all of the expenses. But they might not pay their bill for 2 months, but it doesn't matter. We're not concerned with the cash. We're concerned with recognizing the revenues and the expenses in the same period and matching those. Paychecks are the same. You may be getting paid this week for work that would have been done in April. And maybe right now is not a good example with paychecks, but you get the idea. You're always 2 weeks behind. So in order to have a meaningful financial statement, I have to have ways that I can overcome those timing problems. And at the very foundation of that is what we call the matching principle. So we're going to be coming back to this principle over and over again, especially today. So match revenues in the accounting period with all of the expenses. It allows us to create a meaningful financial statement. Okay, the second principle is the materiality principle. So what it says is that only items that matter will be in the financial statements. And what that really means is that we will track and we will treat the items that really matter differently in the financial statements. So a good example is, how do we treat drinking straws compared to how we treat tequila? So in the hotel world, we buy tequila and we make margaritas and we sell it for a whole lot more than what we bought it for. So therefore, for us, it's material. So we are going to treat it differently when we buy it. We're going to do a complete order. It's going to have the approval. When we receive that tequila, it's going to be locked away under safekeeping. And we're going to use requisitions, and we're going to track it, and we're going to count the inventory, and we're going to keep it under lock and key, and we're going to make sure that the bar is secure. Why? Because it's material. It's valuable. Whereas on the other hand, drinking straws, when we buy drinking straws in our hotels, probably most of us just direct expense them. So they don't get inventoried. They're probably not tightly controlled. And we consider drinking straws to be immaterial. They would be like garbage bags and toilet paper, things that we just go through. Whereas food and booze and wine and all those things in our industry are material. So that's what we refer to as the materiality principle, because we don't have the capacity to treat everything like we treat the tequila, under lock and key, under requisition. So tequila and tenderloin are material in our business. Drinking straws and toilet paper are immaterial. So what we need to be able to do is to figure out what's material and what's immaterial in our hotel. We get to decide. And then once that differentiation is applied, we need to apply it consistently so that every month we do it the same way. So if we were working in another industry, like for instance, the automobile industry, the tequila would be immaterial. Things like wire and rubber and metal would be material. and we would treat them differently. So every industry and every business has the ability to determine what's material and what's immaterial. But once that determination is made, it needs to be applied consistently. Okay, the next one is the business entity principle. Now this one you've probably actually heard about in the media. You probably just didn't realize what they were talking about. But a good example of this is when you read about a company executive and maybe he took his family to Hawaii over Christmas on the corporate jet. Well, guess what? That's not his jet. And the business entity principle says that there's assets and liabilities of the business are distinct and separate from even the executives that operate inside of them, especially in a corporation and a REIT. The business entity principle is really about making sure that only the transactions of the business are entered into the books. So for instance, the company executive flying his family to Hawaii, who's going to pay for the pilots? Who's going to pay the landing fees? Who's going to pay the fuel? If those items were entered into the books as an expense, we've just broken the business entity principle. Shareholders expect that the corporation or the REIT are going to operate in such a way that the business entity principle is not broken. So when you hear about scandals in the paper and executives are doing things they're not supposed to or bending the rules, this is what they're talking about. The next one is the full disclosure principle. And what this really says is that no matter how good the financial statements are, they're never ever going to give you all the information. So in order to give the shareholders and the stakeholders in the business all the information they need, we need to have footnotes. So typical example of this in action in the hotel is the monthly executive commentary or management commentary or owner's commentary, whatever we call it. It's there to provide explanations for what's going on inside of the business. Why did we have a terrible month? What things happened? And also, the full disclosure principle dictates that if there's anything that will affect future earnings negatively, we need to disclose it to the readers of those financial statements. So if we've received a lawsuit and it's not determined whether or not it's going to cost us any money, that needs to be disclosed. If we've got a union and maybe we're going to be going on strike, that needs to be disclosed. If we found that there's a toxic waste dump in the back of our property, it needs to be cleaned up, that needs to be disclosed. Anything that will affect materially the future possible earnings needs to be disclosed. That's the full disclosure principle. The next one is the conservatism principle. And basically what it states is we shall never overstate revenue, and we should always we should never overstate revenue, and we should never understate expenses and payroll. So the question is here, what happened with Enron? Well, Enron was a company in the States that had a terrible thing happen a number of years ago, and what was going on is that the principals in the company were actually manufacturing false invoices and customers and creating revenue and creating profits that didn't exist. So that's certainly overstating revenues. That's making up revenues. And we're not allowed to do that. And at the same time, we need to fully disclose all the expenses and the payroll so that the owners of the company, they expect the accountants to be conservative in everything they do, so that when they're looking at a financial statement, it's believable. And the question at the bottom here is, who regulates the accounting industry? And that's a really important question, because accountants are just like doctors and lawyers. When we look at who regulates those two professions, when we look at doctors, for instance, it's the College of Physicians. So what is the College of Physicians? It's actually an association of doctors. So doctors regulate themselves. When we look at who regulates lawyers, it's the bar. And who's the bar? Well, it's not the bar in your hotel. It's the bar, which is the Association of Lawyers. So lawyers regulate lawyers. It's exactly the same in the accounting industry. Accountants regulate accountants. We decide how we report our information. The government sets certain laws and such as it relates to people breaking certain rules and being not trustworthy and stealing, etc. That's not what we're talking about. We're talking about making sure that we do things in accordance with what our industry is deemed to be the correct procedure. And we need to do so in a conservative way. Okay, we want to anticipate no profit and provide all the possible losses. So in other words, we want to be like this guy is here. We want to be, I think he's probably in church praying. We want to have that kind of a view to presenting the information that we do. Okay, the next one is the consistency principle. So what that means is that we want to have consistent comparison from one period to another. In other words, we do things the same way from one period to the next. Because if we change the way we account for something, like our inventory, go from first in, first out to last in, first out as an example, it will dramatically change the profitability picture. We don't want to do that because, again, the readers of the financial statements, they want to see conservative, they want to see consistent results. They want to be able to trust what's in your financial statements. Another example of something we wouldn't change is going from the cash to the accrual basis of accounting from one period to the next. It would totally distort the results. So we want to be consistent. So the next one is the Objectivity Principle. And this one I'm sure you've all run into, and you can think about it this way. You know, when someone at your hotel wants you to submit backup for something they're looking for, they're trying to hold up the Objectivity Principle. And what it basically states is we need to have evidence for absolutely everything that goes into our books. So when we do a sale, we have to have a restaurant check. When we have something received, we have to have a packing slip. We have to have an invoice. When we pay someone, we have to have a sign-in sheet or a payroll record or a swipe. So we have to have objective evidence for absolutely everything. So what that kind of also means is we can't make stuff up. We can't cook the books. We have to have proof. So the next one is the cost principle. And what the cost principle states is that money is the medium for recording information. It's not beer bottles, it's not rocks, it's not clamshells. Each item is recorded at its cost at the time it is purchased or incurred. And a great example of this is fixed assets. So if your hotel was bought, let's say 5 years ago from another company, or even built 5 years ago from another company, when we look at the books, we look at the fixed assets, the building, the land, the building equipment, they're going to be based on the dollar value at the time it was recorded. That's always what the case is going to be. We don't mark things up to represent current value. We record things at their price we paid at the time they were incurred. That's the cost principle. All right, so I'm going to ask another polling question. But just before we do, I'm going to have Carrie jump in on the last one and see what the types of business ownerships were.
Sure. We had one corp, one REIT, one who was not sure, and the rest were partnerships.
Ah, partnerships wins. Okay, good stuff. Well, I wonder how many of you are kind of wondering whether you were right or wondering at all what the answer is. So like I mentioned earlier, call your boss, find out. It's an interesting discussion. Okay, we have another polling question here, and this one has absolutely nothing to do with what we're doing today. But, you know, given that we're kind of in the throes of principles, I thought I'd ask you an off-the-cuff question. So my polling question is, would you rather have dinner with Justin Trudeau or Justin Bieber? And all you need to do for this is write a T or a B in the chat. T means you'd like to have dinner with Trudeau, and B means you'd like to have dinner with Justin Bieber. And with that, I'm going to move on. Okay, We touched on this earlier, but it's critical to understand because a lot of you in your hotels, you've either experienced this or you're living it right now, and that would be the cash basis for accounting. So in the world of accounting, there are two types of accounting: cash basis and the accrual basis. And if you want to look at it this way, the cash basis is really for much smaller companies where, you know, producing a monthly financial statement is not necessary or they don't have the capacity for doing it. So for instance, my business is cash, which means I recognize the revenues when people pay me, and I recognize expenses when I write a check or when I give someone money. And another way to look at the cash basis of accounting is, it's commonly referred to as the shoebox. So when money comes in, it goes into the shoebox. And when money leaves, when I pay people, money comes out of the shoebox. And at the end of the month or the end of the year, if I look in the shoebox and there's money, that means I've made a profit. If there's no money in the shoebox, or if I actually had to dig into my pocket to pay people because the shoebox is empty, that means I made a loss. But we really don't like the cash basis of accounting because it ignores the matching principle. And it ignores creating a financial statement that makes sense based on matching all the revenues and all the expenses in a current period, because what matters is when we pay people. So we don't like the cash basis. We like the accrual basis. The accrual basis of accounting takes into account the time of the transaction. Whether it's an expense or whether it's a revenue, we want to match them at the same time. Matching revenues and expenses. You're going to hear me say that over and over again, but it's so important. And it does not matter when the money arrives or when the money leaves. This is the way we want to go. This leads to a meaningful comparison, meaningful information comparison, so we can make good decisions based on what's going on inside of our business, because we can clearly see the impact of the direction we're going and the results. Okay. Hotel financial jargon. So I'm going to go over some key phrases that we use. And in our world, we use all kinds of acronyms and all kinds of different things to describe what we're up to. Our business is kind of an old business, so a lot of the terms are kind of from the last century, to say the least. But here goes. We're just going to bring some clarity to some of these items. So the first thing is double entry accounting. Now, if you're using the accrual basis of accounting, you're using double entry accounting. And all that means is there's always at least 2 entries for every transaction. So if I sell a cup of coffee, there's one side of the transaction, which is the revenue, which is the $2 for the cup of coffee. And there's the other side of the transaction, which is the settlement. How did the person pay for that coffee? Is it cash? Did they sign it to their room? Did they pay on their credit card? So there's always at least 2. Many transactions have multiple entries. When you look at how we record the sale of a room, there's room tax, there's provincial tax, there's destination tax, there's GST. All of a sudden, we've got numbers going everywhere. But what's important is the entry always adds up to the same thing, 0, which means it balances, and the debits and credits balance. And there's always at least 2 entries. That's double entry accounting. Accounts. Now, there are 2 main different types of accounts in our accounting world. Balance sheet accounts, which are assets, liabilities, and equity. And these accounts are real and permanent. That means they're there year after year. They never go away. Their balances are always changing, but they never go away. They never get zeroed out. When we look at the other types of accounts, they're income statement accounts, which are our revenues, cost of sales, payroll, and expenses. These are what we call temporary accounts because we only use them for typically 1 year, and then they get zeroed out. And what happens when they get zeroed out is that we roll the profit and loss into the balance sheet in the form of equity. So 2 different types of accounts: balance sheet, income statement, real versus temporary. Okay, here's kind of what they look like when you see them inside of a chart of accounts. So in this case, the gray bar at the top are our balance sheet accounts, cash, sales tax due, owner's equity. Those are the permanent accounts. Then the green accounts are our revenue accounts. The orange accounts are our payroll accounts. Purple, cost of sales, and blue, expenses. Now, this is organized the way it is for this example, but in your hotel, it's going to be organized and look differently, but it's probably broken down into the same main buckets. Ledger. What's a ledger? So that's a really old word, but ledger just means a book. It's a book for recording transactions. But in the hotel, actually, we have a lot of ledgers. We have the guest ledger, we have the city ledger, we have the payroll ledger. And all it means is that it's part of the books or book of accounting. So that when we talk about having the guest ledger is actually everyone who's staying in the hotel. If I was to pull the fire alarm at 2 o'clock in the morning, get all the guests down in the lobby and have a copy of the guest ledger report, all it tells me is what everybody owes me. But when we look at the guest ledger, it could be 50 pages long and have 1,000 names on it because I have 1,000 rooms in the house tonight. But there's one number at the end, which is the total of the guest ledger. And that's what's going to be on the general ledger. So it's the same for the city ledger. It's the same for the inventory ledger. All of these things are just big, long lists that have a number that belongs in the general ledger. Journalizing or booking. Well, all that means is that we're posting to records, posting our records to a ledger. So when we say we're going to book something or journalize it, it's exactly the same thing. All we're doing is recording it. So when I sell that cup of coffee, actually, that's the same thing. I'm booking the revenue for a cup of coffee. It actually gets entered into our books. It might not be there in its singularity. It may be combined with all the other food sales for the day, but it's going to find its way to the general ledger. And it's going to be journalized or booked. What's a journal? Well, a journal is one of the principal books of recording transactions. We have several journals in the hotel. Most popular one is the income journal. So if I was balancing the income journal today, I have all of the transactions from the restaurants and from the point of sale and the property management system in the income journal. And at the end of the day, when I'm balanced, that income journal is then going to be posted into the general ledger. So the source of one part of our work goes into many, many different directions once it's entered into the general ledger. The income journal. What's the income journal? Well, we have tons of transactions that happen inside of our property management system every day. Thousands, sometimes tens of thousands of transactions. So we need to summarize these and be able to add them all up so that we can then post one number for each one of those main accounts into our general ledger. So a great example of this is coffee. I'll sell coffee all day long. At the end of the day, I want to post one number for all of my food sales into the general ledger, but it comes from the income journal. And you got to remember, we're a retail business. So every day we reset our cash register. Every day we have to post what happened from the day before. And it's a key way to control our business and also to capture our statistics. Our business is full of statistics. How many rooms did we sell? How many covers did we serve? How many hours did we work? All these things are really important to be able to track. Okay, the trial balance. I mentioned things being posted inside of the general ledger. Well, the general ledger, when we examine it, it's what we call the trial balance. And why it's called the trial balance is because it actually has to pass a test. The test is it needs to add up to 0. All the debits and all the credits balance. And in today's world, that's controlled by a computer system. But in the old days, when you had to do it manually, it was actually quite a task to add up all of your books and make sure they added to 0 every single time. That's why they call it the trial balance. But it's all the accounts, all the ledgers, everything that is part of the accounting system, one number for each account. It either has a debit or a credit balance, and all of those must add up to 0. And it's a total of all of the balance sheet accounts, the permanent accounts, plus all of the income statement accounts, the temporary accounts. all of those accounts are together in the trial balance. And again, they all must add up to 0. T account. What's a T account? Well, if you've been to business school at all, taken an accounting course, you know what it is, but it's always a debit and a credit. Debit on the right-hand side, sorry, a debit on the left-hand side and a credit on the right. And you probably used it in school when you took your accounting course or you took your business course, and it helps you actually figure out how to post transactions inside of the accounting system. Debits and credits, typically, this is how you find what T accounts look like for assets. In this case, the assets equal the liabilities plus the owner's equity, which is the fundamental accounting equations, debits and credits on each side. But it just allows you to see what the structure is for items entered into the accounting system. Debits on the left, credits on the right. So these accounts that we have, the balance sheet accounts and the income statement accounts, they're what we call normal balances. So assets are normally debits, liabilities are normally credits, equity is normally a credit. If the company is making money, it's a debit. If the company is losing money, revenues are credits. When I sell coffee, that's a credit. Expenses are debits. So when I have payroll expense, it's a debit. It gets posted against the revenue. Credit is the revenue. The debit is the expense. Gains and losses, credits and debits. Prepaid expenses. Well, what are prepaids? Why would I ever want to prepay anything? Well, in our world, sometimes we have to prepay things like property taxes and elevator maintenance contracts, items like that, insurance. And when we pay those items, I'm paying for several periods into the future. So I may pay the insurance bill this month for the rest of the year. And I can't charge this month for the entire value of that invoice for the insurance. So what I need to do is I need to book the appropriate amount to the current month and put the rest as a prepaid so that each month going forward, I can amortize a small portion of those expenses. That's prepaid expenses. Then we have inventory. We mentioned this earlier where we talked about the tequila, but in our world, in hotels, the types of inventory we typically have in our books are food, liquor, beer, wine, spa products. And what's unique about all of these items? There's something that's very unique about all of these items that we always got to remember. This inventory has a monetary value, and in the case of all of these items, I can buy these and sell them for a lot more. Therefore, they're an asset, and I want to be able to recognize that they're material to my business and look after them properly, which means putting them into inventory, locking them up, being able to count them each month and establish the value. The next one is deposits. Well, deposits are actually a liability. And when you think about it, it's kind of odd because you think, well, deposit's a good thing, should be an asset. But the reason why it's a liability is because people have given us the money for their function next month as a deposit, but I can't take that into income yet because I haven't actually earned the money. So it's a liability until those people actually come and we deliver the service. And what's also really important about a deposit, and especially in sales and catering when getting deposits, is, we have to make sure that we always have cash. So we got to make sure that we get deposits from clients because we're holding space for them. Getting that deposit up front gives us a much better chance of making sure they're actually going to come. Bad debt expense. So if we have accounts receivable, inevitably we are going to have customers that don't pay us, but we're going to recognize the revenue when they're here. And if we can't collect all of the account, what we want to be able to do is have a provision. So every month we estimate our bad debt expense based on a formula where we take the amount of revenue in the period and multiply it by a certain percentage of experience. Unearned revenues. So it's not like an unearned run in baseball. Unearned revenues are actually revenues that we can't take into the current period. great example of this is we have a tenant in the hotel, and their contract requires that they pay their rent in advance. So if they give me their rent check this month, and it's actually for the month of June because that's what their agreement says, I can't take that rent into income this month. I have to wait until next month. So we would put it on the balance sheet as an unearned item and wait until the timing is correct. So the typical accounting cycle inside of the hotel, it kind of looks like this, where we record transactions. If you want to look at that in the hotel, it's like doing and selling rooms and selling coffee all month long, selling beer. That's the first step. The second step is we summarize those and we put them as journal entries and we post them into the ledger. Then we create a trial balance. And from the trial balance, we can actually run a report that takes our temporary accounts and shows us what our profit and loss is, and then eventually shows us what our balance sheet is, so that we use all of those transactions, post them into the ledgers, run the trial balance, and then produce the financial statements. And that's what goes on every month inside of your hotel. Okay, deferrals. So what's a deferral and what's an accrual? These sound like scary, complicated things, but defer just means I'm going to push it away. I'm going to defer an expense that doesn't belong to this period into the next period, or maybe even into the next quarter. Accrual means I don't actually have the expense yet. I need to bring it into the current period. So maybe I received some supplies this month, but they didn't give us an invoice. I have to match those expenses for those supplies to the revenue this month, so I need to accrue it. You send me an email saying, David, we received 20 cases of toilet paper. It was $500 on the order. It is here. I need you to accrue it. That's an accrual. Deferral, push away. Accrual, bring in. It allows us to use the matching principle. Reversals. So every time I do an accrual the following month, I automatically need to reverse that accrual, because if that invoice didn't arrive last month for the toilet paper and I accrued it, and this month it comes in, then I've accounted for it twice. So I need to reverse my accrual, put it against the payment, put it against the expense next month. It becomes zero and my expense in the current month stands. That's a reversal. Depreciation and amortization. Again, these sound really complicated, but they're not. Depreciation is simply taking something that has value over multiple periods of time. A great example is the building. The building has a value of $1 million and it's going to last for 40 years. Well, I will depreciate that building every month for the next 40 years. So I'll take the value of the building and divide it by 480, which is the number of months in 40 years. And then whatever that value is, I put that amount into my income statement every single month. Amortization is exactly the same thing, but we're describing something usually like a loan. If I have a loan and I know how much my payments are each month, how much is principal and how much is interest, it's called an amortization. And then I know for the next 40 years I'm going to be paying for that mortgage. I can book the appropriate amount every single month for my reduction of the asset as well as the actual interest expense. Depreciation means I've already got it and I'm depreciating it. Amortization is typically a lease or a mortgage. Accounting adjustments. So you'll hear your people in the accounting department say, we're closing the books, we just have a few more adjustments to do. Well, basically what that means is that these adjustments are anything they need to do to get the matching principle right. They need to do some accruals, they need to do some deferrals, they need to do their prepaids, they need to do their allocations. All of these are to get that finite process to the point where the financial statements make sense. That's what we call accounting adjustments. Allocations, I just mentioned. In our world, sometimes we get invoices where we don't know where it goes. Good example is workers' comp. We'll get one bill every month for workers' compensation. Where do I expense it? Do I put it in rooms, put it in food and beverage? No, I have to allocate it. So I need a formula to allocate it consistently, and the formula needs to make sense. So maybe I'm going to allocate my workers' comp based on the number of employees each department has. Great, fine, document that, do it consistently every month. That's called an allocation. Last one here, store rents, concessions, other income. In some of our hotels, we have other things going on. If you've got any of these, what's nice about those is that it's a different revenue stream. In the case of leased space or concessions, many times this income is 100% profit. So we have no payroll, we have no expenses related to running these endeavors unless we're running them ourselves. But if we've got these as leased space or as a concession, like a car rental place, they're giving us a check every month. It's 100% pure profit. That's what's great about those. And with that, it's time for your questions from today's webinar content. And before we get into that, though, I'm dying to know, given the tight race that it must be, is who wants to have dinner with the Prime Minister? How many people?
Only 2.
Only 2.
Yeah.
Interesting.
Although some people did say they would have dinner with both.
Dinner with both of them. That could be interesting too. I never thought about that.
Yeah.
So Justin Bieber wins. Even
he's got a lot of fans. It looks like.
Oh, that's cute. All right. Well, that was my attempt to add a little levity into the day, and I know that the principles can be interesting, but at the same time, they can also be a little bit heavy. So hopefully that helped. So with that, I want to open it up and see what people have in the way of questions.
Sure. Well, the first question is actually, who would you have dinner with, Trudeau or Bieber, and why?
Well, it would definitely be Trudeau. And the reason why would be, I couldn't tell you one song that Justin Bieber sings. Even if it came on the radio, I wouldn't know it was him. Not that I don't really like the guy. I know he's Canadian. I know he's really popular, but I'd much rather talk about politics with Justin Trudeau. And yeah, that's my answer.
That's your answer. Awesome.
That's fair. I should have expected that one. I didn't.
Yeah, for sure. Here's a question. What is financial leadership, and how is it different from the general concept of leadership?
Well, leadership is all about 2 things, the way I look at it. It's about communicating what's going on. So if you're the GM of the hotel, the department manager, you need to communicate to your team what they're doing, what the message is from the owners, from the brand, what's going on. You're the conduit to give them information. So that's the first thing. The second thing that leadership is about is developing people. Your job is to develop the people that work for you, to develop your teams. Develop them in such a way that they find it engaging, and then all of a sudden you've got a group of people that can move mountains because they're engaged and they want to. So that's leadership. Financial leadership is about understanding that everybody has a role to play financially, no matter what department you're in. If you're in a supervisory role, you've got that element to deal with, and it's about finding ways to be innovative and get people to actually want to do their numbers, because it's the one thing that people will naturally gravitate away from, because numbers are scary, numbers are heavy. But if you're a leader who's got good financial leadership skills, you know how to get people to see that that's really not the case, that the numbers are just how we keep score. We'll have some months that'll be good. We're going to have some months that are not going to be good relative to the budget. That doesn't matter. What are we going to do about it? How can we be more effective around the numbers? That's financial leadership. It's really taking that piece on all by itself.
Awesome. One more question. What's an example of something in the hotel that you would need to record depreciation on if the mortgage is amortized?
Okay, so the depreciation is for something like, for instance, the TV in the bedroom, or the bed, or the credenza in the bedroom. All of those things are assets. We buy them, they have a useful life. The TV is probably good for 5 years. The credenza is probably good for 10 years. The bed's probably good for 7 years. There's actually a book that will tell you how many years each thing needs to be depreciated on. So we would then divide those items by their individual number of months and determine the monthly value. Now with the mortgage, we know the mortgage amount is based on the current interest rate, so we know what the amortization schedule is. This is exactly the same as if you had a mortgage at home. You know what your payment is every month. The only difference is we're looking inside that payment and seeing how much is principal and how much is interest expense, and we're recording it differently. Whereas for you at home, you're just concerned with how much it is because that's how much money you have to have in your bank every month. So that's the amortization.
Okay. How can senior leaders create more buy-in with the numbers in their business?
Well, first thing senior leaders need to recognize is that the financial statement serves two purposes. One is it tells us the score, almost like a game relative to our budget or last year. Are we winning or losing? Are we ahead or are we behind? And the second thing the financial statement does is if we use it properly, it will tell us exactly where to go to fix the problem. It will help us pinpoint the problem. So we got to make sure that when we're presented with challenging financial situations, that we remember it's just a score and that the answer on what we need to fix is right in front of us. And if we can direct people's attention there, it's a lot more effective than, losing our marbles because we didn't make our numbers this month and the owner's going to be upset. And what are we going to do? We're going to have to cut hours and we're going to have to, cut back on expenses and the sky is falling. That's no good. Being a financial leader is all about realizing that I have a role to play here and I can steer this thing in the right direction.
Okay. One more. Why do you teach your clients to prepare expense budgets using a zero base?
Right. So when we look at expenses, there's a couple of different ways that people can produce them. And typically what happens is we look at what it was last year and we just duplicate it. So if it was, say, average of $500 a month last year, I'm going to put in $500 a month this year, or $520 a month for a little bit of inflation. But zero basing means I actually stop and I open up that account and I really look at what am I spending my money on. And then I make a list like I would go, if I was going to the grocery store, I'd make a list of all the things I need, hopefully, rather than just going to the grocery store and going, oh, I want some of this and some of this and some of this, because you come home with a bunch of stuff you don't need, you buy too much, you forget the things you really needed. So zero basing is the same idea. You have a list of all the items that go into each account with the value you want to spend, and then you track back against that because inevitably it won't be correct, but it's a good guide. And then next month, you take what you learned from last month and you apply it and you get better and better at knowing exactly what's in your expenses. That's the zero-based expenses.
Okay. One more. Any ideas on how to get better buy-in on the financials from the frontline staff, front desk, housekeepers, maintenance?
Well, the very first thing you can do to get better buy-in, and a lot of people don't do this, is share the results. If you have a monthly meeting and you go over the financial results, some people are thinking, oh, we don't do that because we don't want people to know how much money we're making or how much we're spending. That's not going to get you very far because if you're not sharing the financial information with people, they're naturally going to be skeptical about what you're telling them or what you're doing. So in order to create some equity with this, you need to share the financial information. And even with the frontline staff, they need to know, the room attendants need to know how busy the hotel is, how much the customers are paying. All of this is really important information, and it creates equity with your employees, that you're treating them like adults and sharing this information with them. And again, one of the hallmarks of our industry is we don't do that, and we haven't done that in the past, but money has a lot of power to shame and embarrass people, so we don't want to show people what we're up to naturally. But the progressive, successful leaders are doing exactly the opposite. They're sharing that financial information. So that's the number one thing you can do.
Okay. Also, what could the percentage of deferrals be during this time of COVID that would make sense without harming the business in the future?
Well, we can only defer something if it really belongs to a future period. So I know we use that word in the sense of maybe the bank is deferring our mortgage payments right now. And that's something different because they've agreed to actually let us not make payments. So that's kind of a sidebar agreement. But when we talk about the books and we talk about doing deferrals, we're talking really about items that belong in another period. So for instance, if I paid a bill this month for something that was going to be delivered in July, but I needed to pay it now, I would defer the expense to July when the item actually comes in.
Okay. And that was our last question. It's
okay. Wow. Good stuff. Well, listen, I don't know who did their homework last week, but guess what? I've got more homework to send you guys. So I'm going to tell you a little bit about it. There's a link I'm going to send you that talks more about the basic principles. And I want you to read it, but I want you to save that link, because I can guarantee you at some point in the future, you're going to come across these principles and you're going to go, oh, I know exactly where I can find a really good definition of that. And I'm going to challenge all of you as well. When you get back to work and you're having a staff meeting, teach these principles to your team. Do one per month. Teach them about why we do things the way we do. So when it comes to taking inventory, if you're running the housekeeping department and you're counting some things and not counting other things, that's all about the consistency and the materiality principle. So teach your people these things. It will really help them understand what they're doing. And then I'm going to send you a really short online quiz you can take and test your own knowledge on the basic principles. And then I'm going to send you 2 additional blogs to read that I have written. One called The 2 Degrees of Separation, and the next one is The Next Big Thing. So I'll follow up after we wrap things up today or early tomorrow morning with those links to everybody, as well as a copy of today's riveting session on principles. So like I said in the beginning, we're building a foundation. This is definitely, the bricks and the cement that we probably will never see again. But it's really important that people understand why we do things the way we do. So appreciate everyone's attention to this today. And with that, remind everybody that I've got wonderful tools and treats. If anybody wants them, just send me an email. And also sign up for my free guidebook. You'll get my weekly email. And with that, I want to say thank you. And I think we're pretty much on time.
Yes, thank you very much, David. And please join us next week for our 3rd webinar. Same time, just use the same link. If you find that it doesn't work, please email me and I will send you the link directly. And the recording will be available in the next day or so. Thanks again for joining us.
And just a little teaser there, next week we're going to be talking about financial statements, getting into some of the applications of what we learned today, but it's really going to start to put a picture together that people will be able to relate to their hotel. Excellent. Okay, thank you, everybody.
Thank you.